Going to walk through one of the most critical, but often underestimated, areas of compliance, payroll. Specifically, we'll look at the most common payroll mistakes, why they matter, and how to avoid them in a practical, sustainable way. This session is especially important for organizations employing sponsored workers, where payroll isn't just about paying people correctly, it's directly linked to your legal right to operate. Let's start with a simple idea. Payroll is no longer just a finance function, it's a compliance function. Every payslip, every submission, every data point feeds into government systems. That includes HMRC reporting through real-time information, or RTI, and increasingly, that data is cross-checked by UKVI. That means inconsistencies are no longer hidden, they're visible and they're actionable. Mistakes in payroll can lead to financial penalties, HMRC investigations, loss of sponsor license, and ultimately business disruption. UKVI will cross-check HMRC, real-time information data salaries, any hours changes, leave or absence taken by a worker, mismatching information on the sponsor's management system, SMS. Real-time information, RTI, is a system introduced by Revenue and Customs, HMRC, that requires employers to report employees' pay and deductions every time they are paid, rather than submitting information annually. RTI is important because it ensures employees' tax and national insurance are calculated accurately in real time, helps HMRC keep up-to-date records of income, reducing errors supports benefits. Systems like Universal Credit, which rely on current earnings data, reduces end-of-year reporting burdens, like P35 forms which RTI replaced. In short, it keeps payroll reporting timely, accurate, and transparent. Full Payment Submission, FPS. An FPS is the main RTI report. It includes employee pay and deductions, payee tax, national insurance, student loan repayments, if applicable, statutory payments, e.g. maternity pay. You need to submit on or before each payday. Every time you pay employees, you must send an FPS to HMRC. This is the core of RTI compliance. Employer Payment Summary, EPS. An EPS is used when adjustments or additional information need to be reported. This includes statutory payment recoveries, e.g., reclaiming statutory sick pay, apprenticeship levy adjustments, periods where no employees were paid, CIS deductions suffered, for contractors. You need to submit this, usually by the 19th of the following tax month. You don't send an EPS every payday, only when needed to correct or supplement FPS data. Deadlines and late submission penalties. The FPS must be submitted on or before the date employees are paid. EPS should typically be submitted by the 19th of the following tax month. Late filing penalties depend on the number of employees. 1 to 9 employees, £100 per month. 10 to 49 employees, £200 per month. 50 to 249 employees, £300 per month. 250 plus employees, £400 per month. Additional penalties. Interest on late payee payments. Extra penalties for deliberate or repeated failures. Payslips and hours records. If someone works 40 hours per week, the payslip should show 160 hours per month. Any leave taken must appear in the payroll breakdown, RTI submission, and internal records. Now let's shift focus slightly to monitoring. Payroll doesn't operate in isolation. It's part of a wider compliance framework. You should be actively monitoring absence patterns, sickness trends, unpaid leave, requests for reduced hours. This matters because all of these factors can impact salary and reporting obligations. For example, if someone takes extended unpaid leave, their salary may fall below the required threshold. That's not just a payroll issue, it's a sponsorship issue. Any significant changes must be tracked, documented, and reported where required, and importantly, you must maintain an evidence file. If it's not documented, it didn't happen. There has been cases that have been challenged in courts where UKVI have revoked sponsorship from looking at HMRC data. Monthly payroll checks. Let's move into something practical. Your monthly payroll control check. Think of this as your internal safety net. Each month, you should be asking, was the full payment submission sent on or before payday? Was an employer payment summary submitted if needed? Do payslips reflect contracted hours? If someone works 40 hours per week, the payslip should show 160 hours per month. Does RTI match the payslips? Does salary match the sponsorship record? You should also check that there are no unlawful deductions, that any authorized deductions are properly documented, that salary thresholds are maintained, that payroll is fully reconciled, and that any variances are investigated. This isn't just admin, it's evidence of compliance. If you were audited tomorrow, this is what would protect you. Workplace pensions and auto-enrollment. Another important area is workplace pensions. Your responsibilities include assessing employee eligibility, enrolling qualifying staff, making correct contributions, integrating this into payroll. And don't forget, re-enrollment is an ongoing requirement. Mistakes here can lead to regulatory penalties, employee complaints, and reputational damage. Employers cannot make deductions directly from wages and payslips. There must be a separate agreement in place if the worker is required to pay for rent or uniforms. Sponsors will get an instant revocation if the UKVI find payments are being deducted directly from wages. There must be documented agreements for any required payments the worker needs to pay for rent or uniforms. What payroll records must be kept? Employers must keep accurate, complete payroll records for every employee. These typically include employee details, full name, address, date of birth, national insurance number, start and leaving dates, job role and employment status, pay and deductions, gross pay and net pay, PAYE tax deductions, national insurance contributions, student loan or postgraduate loan deductions, pension contributions, including auto-enrollment, statutory payments. You must have records of statutory sick pay, SSP, statutory maternity pay, SMP, statutory paternity pay, SPP, statutory shared parental pay, SHPP, supporting calculations and eligibility evidence. For RTI submissions, you will need copies of full payment submissions, FPS, employer payment summaries, EPS, dates sent and confirmation receipts, payments to HMRC, PAYE, and national insurance contribution amounts due and paid, dates of payment, any interest or penalties applied, other supporting records, such as timesheets or hours worked, expense and benefits records, PAYE coding notices, P6, P9, contracts and salary agreements. HMRC requires payroll records to be kept for at least 3 years from the end of the tax year they relate to. For example, records for the 2023-24 tax year must be kept until at least the 5th of April 2027. Recommended best practice is to keep records for 6 years, as this aligns with broader accounting and legal requirements. Here are some practical steps you should take. Review internal procedures. Ensure you have robust systems in place to identify, record, and report changes in pay, location, job role, and absences as soon as possible, and at least within 10 working days. Audit sponsored workers' files. Check that all sponsored workers are being paid in line with the correct salary thresholds, have up-to-date HR files, and check whether any changes need to be reported. Unreported changes, such as time spent on maternity leave, resulting in a reduced salary, can cause salary data to appear non-compliant when compared with HMRC records, and it flags reporting breaches. Review recruitment policies. Confirm that the recruitment and onboarding of sponsored workers strictly comply with the immigration rules. Provide refresher training. Offer refresher training to HR teams, key personnel, and line managers so they understand their reporting and record-keeping obligations. HMRC audits are not conducted at random. Rather, they are typically prompted by identifiable patterns or risk indicators within an organization's payroll and compliance practices. Understanding these common triggers can help businesses maintain robust processes and reduce the likelihood of scrutiny. One of the primary factors that may attract HMRC attention is the submission of late or inconsistent real-time information, RTI. Regular delays or discrepancies in reporting payroll data can signal underlying administrative or compliance issues. Similarly, problems with PAYE payments, such as late payments, underpayments, or irregularities, may raise concerns about an organization's financial controls and adherence to tax obligations. Compliance with national minimum wage and national living wage regulations is another critical area. Any indication that employees may not be receiving the correct statutory pay can prompt further investigation. In addition, errors in payroll reporting, whether due to miscalculations, incorrect employee data, or system issues, can increase the risk of an audit. HMRC may also focus on employment status concerns, particularly where there is ambiguity between employees and contractors. Misclassification can have significant tax implications and is therefore closely monitored. Likewise, unusually high or inconsistent claims for statutory payments, such as sick pay or parental leave, can appear anomalous and warrant closer examination. Rapid or significant changes within a business, including sudden growth, restructuring, or shifts in payroll size, may also act as triggers, as these changes can sometimes lead to transitional errors or gaps in compliance. Finally, organizations with a history of previous compliance issues are more likely to be subject to further review, as past behavior is often used as an indicator of future risk. By recognizing these common audit triggers, businesses can take proactive steps to strengthen their payroll processes and ensure ongoing compliance with HMRC requirements. Preparing for an HMRC compliance check. Before a check, make sure you can easily provide payroll reports and summaries, RTI submission records, FPS, EPS, employee files and contracts, evidence supporting statutory payments, reconciliation between payroll and accounts. What HMRC will look for: accuracy of PAYE and NIC calculations, correct tax codes applied, proper treatment of benefits and expenses. Worker status, employee versus self-employed. Timeliness of RTI submissions and payments. How to prepare effectively. Reconcile payroll to HMRC account regularly. Run internal audits or checks. Keep documentation well organized and accessible. Ensure payroll software is up to date. Correct errors promptly, and report via RTI if needed. We are going to look at a case study: underpayment and HMRC UKVI data matching. A domiciliary care provider sponsored multiple care worker visas, but paid them less than the salary stated on their certificates of sponsorship, partly due to unpaid travel time between visits. HMRC identified national minimum wage breaches during a payroll inspection and issued arrears and penalties. UKVI cross-checked HMRC data and conducted a sponsor compliance visit, finding systemic underpayment and inaccurate records. The sponsor license was revoked for failure to meet salary and sponsor duties, and sponsored workers were given curtailment notices. Underpayments for travel time have become a common area where breaches have occurred, so we are going to look at this in more detail. Travel time is when workers are required to be traveling in connection with their work. Any travel from home to the office or the first care call, or from the office or last care call to home is not part of working time. This is the worker's commute. Travel time stops for rest breaks, e.g. the worker drives to the shops to buy food as they are traveling to take a break. If the worker is traveling to the next care call when their break is finished, this is classed as working time, and has to be paid as working hours. Let's look in detail at what you need to pay Jane for her day's work. Jane leaves home at 8:45 a.m. and travels to her first appointment at 9 a.m. Jane works from 9 a.m. to 10 a.m. Jane travels 20 minutes to her next care call and has to wait 10 minutes. Her second care call is from 10:30 to 11:30 a.m. Jane travels 30 minutes to her next care call. She works from 12 p.m. to 12:30 p.m. Jane takes a 30-minute rest break, and then drives to the next care call, which takes 20 minutes, and has to wait for 10 minutes. She works her fourth and last care call, from 1:30 p.m. to 4 p.m. Jane drives home and arrives at 4:30 p.m. Even though Jane left home at 8:45, you do not pay her for the commute to work, the first care call, and you don't need to pay her commute home. Jane does not get paid for the 30-minute break. For her day's work, you are paying Jane for the total working time of 6.5 hours. How this is calculated: care call 1 is 1 hour. Travel time is 20 minutes. Wait time is 10 minutes. Care call 2 is 1 hour. Travel time is 30 minutes. Care call 3 is 30 minutes. Travel time is 20 minutes. Wait time is 10 minutes. Care call 4 is 2.5 hours. If travel or waiting time is not paid, it reduces a worker's average hourly pay, which may cause their effective rate of pay to fall below the national minimum wage. This underpayment would be reflected in payroll records, as insufficient wages for the total hours worked and could lead to serious consequences, including HMRC enforcement action, repayment of arrears to workers, financial penalties, and potential reputational damage for the employer. An effective and robust payroll framework is founded on strong coordination between payroll, human resources, and compliance functions. Close collaboration across these areas ensures consistency, accuracy, and alignment with regulatory requirements. This is further supported by the implementation of regular internal audits, which serve to identify potential risks, validate existing processes, and maintain ongoing compliance with evolving standards. Comprehensive documentation and meticulous record-keeping are also essential, providing a clear audit trail and ensuring transparency across all payroll activities. In addition, the delivery of accurate and timely real-time information, RTI submissions, remains a critical obligation, underpinning both regulatory compliance and organizational credibility. Continuous monitoring of employee data and payroll activity enables the early identification of irregularities or changes requiring attention. Where discrepancies are identified, prompt and decisive action is taken to mitigate risk and ensure resolution. Ultimately, while each of these components is vital, they are all sustained by a fundamental principle: a strong culture of compliance. Such a culture fosters accountability, reinforces best practice, and ensures that compliance is embedded across all levels of the organization.